Hello, and welcome to the June 2022 Economic and Market Update, presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. Markets started to stabilize in May. While they moved up and down during the month, both the Dow and the S&P 500 ended up with small gains, while the Nasdaq's loss was small by recent standards as it bounced back from mid-month lows. International markets edged up by somewhat more than U.S. markets, while fixed income also showed gains. After a terrible start to the year, it was nice to see some green, even if the gains were limited. And just as with last month and the year so far, the primary driver here was interest rates. And for a change, the news was good as they showed signs of stabilizing. Although the Fed raised rates last month as expected and inflation remained high, in both cases there were signs that market worries had outrun the actual data. Inflation showed signs of peaking, while concerns about the Fed's expected rate increases started to tick down. The yield on the 10-year U.S. Treasury note bounced around but ended the month at about the same level where it started. And with interest rates stabilizing, markets once again followed their lead and started to level out. Beyond interest rates, other concerns also showed signs of stabilizing. Although COVID cases rose here in the U.S., both spending and growth continued to be strong. Worries about mass COVID lockdowns in China remained, but faded as supply chain disruptions haven't immediately appeared. Similarly, while the war in Ukraine continues, it too has shifted to a chronic risk rather than an immediate one. So while risks remained in May, the perception of those risks moderated significantly, and that certainly helped stabilize markets. Also helping to support markets, the economic news remained positive. Hiring remained strong, supporting spending growth, and business investment remained healthy as well. Looking forward, the question is whether that'll continue. There are real signs of softening, especially in the consumer and housing sectors, as higher prices have hit both earnings and spending power. Confidence, although it remains outside the risk zone, continues to trend down. The risks to the economy are increasing. But here, too, the factors that have stabilized the market should help. As rates stabilize, so will the economy. As the housing market softens, prices should become more affordable. And as inflation moderates, real wages will recover, especially as the labor market remains strong. On the whole, while growth is slowing, we see little or no direct fundamental damage in the data yet. In other words, while real risks remain, as far as the economy is concerned, we're still growing. And that solid economic performance, combined with the pullback and worries about interest rates, explains much of what happened in May. As inflation slows and the Fed starts to moderate its policy tightening, and as the economy keeps growing, markets are stabilizing at lower valuations. And once stabilized, they can then move higher again on rising earnings. It has been a painful couple of months, and the pain may not be over yet. But as painful as this has been, it's setting the stage for future growth. And we're now well into the process. Now, that's not to say we're done with turbulence. Interest rates could rise further. COVID could surge again. The Ukraine war could expand. And when and if those bad things happen, we will see more market volatility. But despite the headlines, over time, the fundamentals are what drives both the economy and the markets. And although we're feeling some pain as we return monetary policy back to normal, the worries are starting to subside to something more realistic. And that's the bottom line here. Lots of bad things could happen, but most haven't, and most won't. And as markets start to reflect more what's likely to happen rather than what might happen, we're seeing more stability. The risks are real, but despite those risks, the fundamentals are still sound. And while we've seen substantial volatility, and we may see more, that provides a good foundation going forward. That's it for this update. Thanks for watching. Join me in July for the next one, but until then, be sure to check my daily blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.